welcome back to another video, and today I'm here to talk about how I've made money in the stock market, my investing strategy, and how I think it's so easy to make money in the stock market. So if you guys do enjoy this video, be sure to smash that like button, also subscribe to the channel. I really appreciate the support, and let's get right into it. So how to make money in the stock market. This is my stock portfolio. I have $28,000 going on 30,000. We're at an all-time high right now. I'm up 69% year to date. It's been a great year. This is one of my first years taking investing very seriously. This is my public account that I share with you guys. I have a few others, but this is the one that I talk about the most. Really, there's only 3 easy steps for investing. I'd say that it's how to buy. You need to see how to buy these stocks. Obviously, you need to buy them on a trading platform, but how do you decide which stocks to buy? When to buy? So you need to know when to buy the stocks. It is time in the market, not timing the market, but there is ways to mitigate your risk. And then what to buy. So what are you buying? What are you buying it for? When are you buying it? There's a lot of things that go into buying these stocks. And then you repeat that. So let's get into that. I actually wanted to open up some of these, different sources that we have here. One of them is market-io. This is a site that I've been using a lot. You guys can use my affiliate code down below for a free trial. So you need to find a site, not necessarily a site, but it helps a lot. You need to find one of these where you can look at information about stocks. So for example, let's look at my portfolio. I'm gonna be very transparent this video with you guys and just show you a lot of things that, have helped me a lot because I want to help you guys out. So let's see AMD. AMD is a stock that I've invested a lot in. I'm up over 122%. This has probably been my most successful investment money-wise, not percentage gain-wise. So percentage gain-wise probably might be SoFi, almost 200%. So if we go to Market Dash, let's check out AMD, okay? AMD right here, it shows their financials. So when we go to AMD, we're going to see, okay, the stock is, they're up 2% today, $235, but we see their revenue, PE ratio. PE ratio is a very important one. This is how you're going to, kind of grade the stock. And then there's a lot of information here that helps out a lot. Definitely if you want to, get deeper into the stock, a deeper dive. We see AMD, it says it's overvalued. So you can use your own metrics for that. But this is another great thing to look at. We see that there's a lot of very rich, very smart people that hold a lot of AMD. So they're putting their money, really where their head is. And same thing with this, there's price targets. So you kind of want to just take everything with a grain of salt because at the end of the day, this is all opinionated and nobody knows where AMD is going to go. But you need to come to that consensus on your own. So like example for me, I'd say, okay, AMD's revenue is, hiking up. I think AMD's looking pretty good here. The revenue TTM, it's going up pretty well. It's not stagnant. Same thing with their revenue year over year growth. It looks pretty good for this company. Their free cash flow, we're seeing that's looking all right as well. Margins are staying the same. Gross margins are also the same, so I'm not worried about that. Balance sheet, that's another thing you can check out. They have 75 billion of assets, 15 billion of liabilities. It's a very profitable company. But for example, so AMD right now, I might not buy. I might say, okay, their PE ratio is 131, which is price to earnings ratio, and I don't want to buy AMD because I got AMD when they were a lot cheaper. AMD is still a great stock. I still think it's a buy right now, but I think that there is other opportunities out there. For example, Cheesecake Factory is a stock that I'm actively buying heavily. I own this one for average cost of $47, but if we go over to Market Dash right here, let's look up Cheesecake Factory, ticker symbol cake. I think they should change that because it's inaccurate representation of Cheesecake Factory. If you guys do want to know more about Cheesecake Factory, where I go more in depth, I'd check out my video from yesterday where I talk about 3 non-tech stocks to buy right now. But for example, Cheesecake Factory, very attractive to me because their PE ratio is only a 17. This has to do with which industry they're in and, things of that nature. So with the restaurant industry, it usually is lower margin. So the PE ratios are lower, very opposite from the tech industry where PE ratios tend to be a lot higher. So you want to check with other stocks similar in their sector and see what they're doing. And then let's check, other things like this. We see they have very good, they're talking about strengths, weaknesses, threats, opportunities. So it's very good, AI information right there. We see they think Cheesecake Factory is undervalued by 36%. With their intrinsic value, that's some calculations that they're doing to get that up. Not a lot of big companies holding Cheesecake Factory with at least a lot of their portfolio. So that's another thing to take into account. But when I look at the company, I believe in it because I see, okay, the target price is 70, the low target price is 39. And I look at the financials, what this company is doing. I think their revenue is increasing steadily. We go to their valuation here. We see their PE ratio is very low, very low. It's 17. I think with the growth that this company has, it can be a lot higher than that. So I do think that that is very bad for this company. And then there's other things that you can look at as well. But then we look at their balance sheet as well. A lot of liabilities for this company because it's debt heavy. I mean, non-current debt. So this means, they're leasing buildings for long term, which makes a lot of sense when you're opening a lot of restaurants. But this is great. This is great information. You need to see the financials before anything else. But what I love to do is look at these companies' presentations. So if you guys have watched my videos, you'd see that I do always use companies' investor presentations when I'm looking at their stocks because this offers a plethora of information that you can't get anywhere else, and it's coming straight from the company. So this one for Cheesecake Factory, for example, and some of the companies that I invest in don't have these. This is definitely a luxury to have an investor presentation, but Cheesecake Factory is one of the ones that does it the best. They have one of the most, attractive investor presentations, giving a lot of great information. But for example, if I didn't look at this, I wouldn't know. The Cheesecake Factory has 216 locations. They have 46 North Italia locations, 42 Flower Child locations, and 52 Fox Restaurant Concept locations. What is that? I thought I was just buying the Cheesecake Factory. Exactly. So there's a lot of things that you wouldn't know if you didn't check the investor presentation. It's very important to look at that when you are investing in these companies. So there's a lot of information on here that would have been hard to find online even. But I mean, just beyond that, it's all right here in front of you. It's easy to see. And they're talking about you got to take it with a grain of salt. This company wants you to invest into them. But at the same time, they're talking about all their businesses, all their ventures with, a lot of backing to their statements and claims. They're not going to lie on their investor presentation. So very important piece right there. Let's take a look at AMD's as well. This is just, I want to contrast these two because AMD, unlike Cheesecake Factory, is a little more straight to the point. They do have, a data center client gaming embedded. So AMD also spices it up a little bit. But for example, like Google and Amazon's investor presentation, if you guys check those out, it's just numbers. People are, they just have graphs on there and numbers. They don't have time for all of this. But AMD, it gives great comparisons. Their operating income is down. Their diluted earnings per share is up. We see their P&L summary. This is very important. We're seeing how they are compared to last year. They're up 32% on revenue. Gross profit up 7%. Do I want to invest in a company that's losing money? Do I want to invest in a company that's making money? Their data center segment is up 14%. Client and gaming segment is up 69% year over year. So I feel very confident about buying this company because of these, segments up. Embedded segment is down. Maybe that's, taken away from that. But you really got to do your own research with this. That is part of, like I said on the slideshow right here, how to buy. Part of that as well. When to buy kind of comes into the PE ratio a lot. So I'm a strong believer of PE ratios. I think that they're very reflective of the stock and its valuation. And some stocks deserve to trade at higher PE ratios. So if we look at Cake right here, it's trading, and stocks trade at PE ratios for a reason. Okay. A lot of the times I think you want to look for stocks with low PE ratios in sectors where the PE ratio is typically higher. The median PE ratio for the restaurant industry with, these kind of growth rates, I'd say I'd compare it to maybe like Chipotle. I'd say that Cake is nearing that stage and they have a 36 PE ratio, and you got to think of it is price to earnings, so the stock price to their earnings ratio. So Cheesecake Factory, if they had a 36 PE ratio, they'd be double the stock they are right now. And then we look at maybe Wingstop, I'd say also comparable to what I think Cheesecake Factory is going to do in the future. They have a 43 PE ratio, so that would also be, 2.5 times what they're doing right now. So there's a lot of ways that you can compare these. Like, for example, I'd say that you can't only use the PE ratio. You got to know a little bit more about the company, but that's where the investor slideshow comes into play. Like, for example, Google, a stock that I really like, their PE ratio is gaining, but it is 26.9 right now. We compare that to Apple, whose PE ratio is a little bit higher than that. It's not 26.9, it is 39.29. So very much higher. Google would need to rise about 50% to reach that PE ratio, and I think that will happen pretty soon. But Google is a great buy because they have a lot of other things where I've looked into the company. They have Waymo, they have YouTube TV, just hit after hours right here. But they have a lot of things where I'm thinking, okay, Google's a great buy right now. I really like Google, and their PE ratio is low. So that's what comes into the when to buy. That's how I know, okay, it's time to buy, because time in the stock market is very much more important than timing the stock market. So let's take a look at Google's a great example actually of a stock in this regard. So you got to have time in the stock market, because look at this stock. It just hit an all-time high right here. This is an all-time high for the stock, $204. It rose 25% after that. Just like that, in the snap of a finger. So if you're saying, oh, Google's at an all-time high, I'm going to wait till it drops, you just missed out on 25%. So that's opportunity cost and you're losing money. You're probably invested in something that went down. There's a lot of things that can happen from not investing. Like I bought Google right there at an all-time high. I own Google at its old all-time high. Now I own it at its new all-time high. The company now has reached a new all-time high. That is what these great companies do. But I mitigated my risk by buying Google. Therefore, I bought Google when its PE ratio was even lower than this. Its PE ratio was in the low 20s. I think it was 23, 22, which is insane. So I said, okay, Google's PE ratio is that low. I see their innovation. I think this company is worth more. So I bought some Google, and then it's paid off pretty well so far. I didn't buy a lot of it. I'd like a little bit more. But Google is a company that I believe in as a whole, and then they're backed by, they're very pricely, or they're priced very cheaply in comparison to their peers. So I bought a little bit of Google and it's worked out. That's what my investing strategy is. I want to buy great companies for low prices. So I'm also not married to a stock. So this is the last point. 3 easy steps what to buy. You can't have emotions in the stock market, basically, is what I'm saying. So if you do have emotions in the stock market and you're investing in things that you think are going to go up, you feel married to a stock, you say, oh, I have to hold it, I've held it for so long. You shouldn't invest in the stock market. It's not meant for you. And that's the harsh truth. I don't think the stock market is meant for you. If you are having those feelings, it's not worth it for you to invest into the stock market because you're probably going to lose money. You need to have a certain mindset, a certain mentality when investing in the stock market. And then an easier way, I invest in single stocks because I'm more risk on. I'm younger. I feel like I can take the risk. It's all up to you personally. But for more people that aren't more risk adverse, maybe they want to invest in an ETF, which I'd very much suggest to everyone just starting off in stocks. I've been doing stocks for a while now. Not as long as some people watching this, I'm sure, but I have been doing it for a good amount of time to the point where I feel confident in investing in these singular companies. I buy single stocks. I'm a stock picker. I do want to buy ETFs too. I do want to balance out my portfolio, especially once wealth preservation is the goal, not, growing my capital. So VOO, this is a ETF. These are the definition of time in and not timing. These always hit new all-time highs. These are ETFs. As long as the GDP is growing, as long as the economy is growing in America, this ETF is going to go up, which it has been every single year. We see that this ETF in particular is a great one, because its expense ratio is so low. It's 0.03. You definitely want to check that out when investing in ETFs. But we see since inception on September 7th, 2010, they've returned 14.9%. So that's very good right there. And one of my favorite ETFs, like my favorite ETF, one that I have held over time, I really like SCHG, have it in some other portfolios actually, returned 16.77% since 2009. So this company has done very well for itself, especially as an ETF. So that's why it's my favorite ETF. But then there's more standard ones like SPY that's returned around 10%, but they've done so since inception all the way back in 1993. And then there's ETFs that have been around since the 50s that return 10%. So that's where this investment calculator comes into play. Let's just make a real scenario. Maybe let's say you're 30 years old, you want to retire when you're 65. That's 35 years. You're starting with, you scrape together $1,000. You're returning 10% a year. You just invested in an ETF. It's compounding annually. And then at the beginning of every month, let's say you'd put aside $500. This is in 35 years. You'd have $1.7 million. That's a good amount of money, especially from $500 a month, $6,000 a year. That's pretty much like investing in a Roth. So if you did put this in a Roth IRA and you're 30, there's always time. That's what I'm trying to say. There's always time to invest. There's always different things to invest in. You can go more risk on, more risk adverse. You can go very safe. You could just put your money in a money market account and make, whatever the rate is at that current moment. But I myself think that there's a lot more value in investing in the stock market, and return rates may even rise with, AI and everything that's going on in that sense. But also if you invest in SCHG, which is returning 16.7% with this same amount of money, same time, same everything, this 1.7 turns into 8.8 million. So if you can consistently make 16% a year for 35 years, by all means, you are outpacing everyone. Because time is really your friend on this as well. So if we take this, let's do the same 10%. Let's look at this again, 1.7 million. Let's say instead of when you're 30, you start when you're 20, you have 45 years. That turns into 4.6 million. So you're investing pretty much the same amount of money. It's in the 200,000. So we add 10 years onto that. You're only investing, 60,000 more. you're making over 3 million more. So there's a lot of interest that you get out of those 10 years. And then let's say, you just had a kid and you want to invest for them when they retire, and maybe we do a little bit less for this. Let's be more realistic. Maybe you put $100 a month in. And let's say just give it to them when they're 18, actually, right? When they're 18, they'd have a total of $63,000 by the time they turned 18. Insane. I mean, from $100 a month, anyone can put, don't go out to eat as much as you are. There's a lot of ways that you can put $100 a month aside, I think. And I'm going to link this down below for you guys under the free trial link for Market Dash. But this is a very helpful tool, and I very much suggest that you guys try to use this because it really puts into perspective what can happen. Because let's say and when they're 18, they continue to invest $100 a month, they'd have $7 million by the time they retire from $100 a month. So if they, they only contributed 78, they didn't even put in $100,000. They made 7 million almost. So, I mean, obviously there is inflation. Obviously there's things like that, which people are quick to call out when I use this calculator, which yes, I totally understand, but that's only 2% a year. I mean, in 65 years, will that be significant? Yes. But I think, you're still going to be rich. By no means is $7 million going to be nothing in 65 years. So really prepare for the future with this. You need to be a long-term thinker when investing. If you're not, if you're buying stocks and selling them, weeks apart at a time, then you're a trader. You're not an investor. You're trading stocks, you're not investing in them. So I invest in companies. I don't trade them. I don't buy and sell over short periods of time usually, unless, I'm doing it for fun. I love investing in companies. I love looking at their balance sheets. It's something you got to fall in love with. You got to be really into to actually enjoy it. So if you guys did enjoy this video, that is all I have for today. Just wanted to show you guys how I've grown my portfolio to over $28,000 over in the past year here. So if you guys did enjoy this video, be sure to smash that like button. Also subscribe to the channel. I really appreciate you guys for watching, and I'll catch you in the next video tomorrow. We post daily content every single day. Thank you. Peace.